The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Welcome to episode 150 of Wealth Talk. My name's Christian Rodwell, the Membership Director for WealthBuilders. I'm joined today by our founder, Mr. Kevin Whelan. Hi, Kevin.
150.
Woohoo!
I didn't know I liked you that much, Chris. I could stand talking to you every single week for 150 weeks.
I think 2019 we kicked this off, so yeah.
Well, that's interesting. I mean, it's good to know that we're giving messages that are being well received, or at least well received by many. Not by, mind you, somebody's probably listened to all of these episodes, Chris. What do you think about that?
Yeah, maybe there's a good time if someone's listening now has listened to all 150 and hasn't left a review yet. Why not tell us what you think? And that would be a nice little birthday anniversary present for us.
Yeah, well, that would be good. Happy anniversary, Chris.
So we're face to face together today. You can probably hear that at WealthBuilders HQ. And we're continuing the theme. So we kicked it off last week with 7 ways to tackle inflation. We know, obviously, prices are rising out there. You can see it when you go and get your coffee at Costa, or you do your weekly shop, or your petrol.
Yeah. I've got electric cars.
Well, so have I. So we don't get hit quite so badly there. But we know that, obviously, cost is really significantly rising at the moment. So go and check out last week's episode, 7 ways to tackle inflation. But today we've got our wealth coach, Manish Kataria, who is obviously an expert in the area of finance and stocks and all things market-based. So a bit of a broader look at how inflation is affecting the markets. Yeah,
so, I mean, look, he's a man of credibility, so we must listen to what he has to say, and I think you'll pick up some themes going through there, particularly, a style of what he says are inflationary pressures in all markets. And we'll debrief that at the end. The importance of using tax-free things, wherever you get a gift, as he calls it, you could use that. And simplicity over complexity, Chris. Some really good messages coming from Manish today.
Yeah, so let's dive straight into it then and head over to our conversation with Manish Kataria. Manish, welcome back to Wealth Talk today.
Hi, Chris. How are you doing?
Very well, thank you. And we were just looking back to see when you were last a guest, and it was actually all the way back in the summer of 2020, so right in the middle of the COVID crisis. And I know we were talking about similar things then with the economy and lots of concern out there. And there's a bit of concern out there at the moment, isn't there?
There is. There's always concern. Whether we're talking about the economy or politics and markets, and there's always a concern. And what we call, how we refer to these kind of concerns, we call them a wall of worry. So markets climb a wall of worry, and there's always something around the corner, right? So there's pandemics, there's war, there's inflation, there's recession fears, and there's somebody always points to something to deter investors to invest, and without those concerns, I guess markets wouldn't keep going up. We kind of need those concerns to keep people on their toes and to enable markets to keep going up over time. So there's always something, Chris.
Yeah, that's right. And obviously our members will know you very well, Manish. You're one of our wealth coaches, have been for over 2 years now. But tell our listeners a little bit about yourself before we really get stuck into the main conversation today, which is going to be focused mostly around inflation.
Yeah, sure. So I'm a wealth coach with WealthBuilders, and I've been doing that for a couple of years now, I think. Is that right, Chris? Couple of years I've been with WealthBuilders, so that's really good. Really enjoy working with your members, sort of providing guidance around business and investing. So I really enjoy doing that. I have a background in investment management, so I'm a professional investor by training. I used to work with JP Morgan, managing money with JP Morgan, and I've worked at other blue chip investment houses. So that's my kind of background. I'm still doing that on a part-time basis. I still work in the city on a part-time basis, but nowadays I get to sort of choose my own hours. So I'm not sort of working full-time in the corporate life. I sort of run an investment program. I run Invest Like a Pro, which is a network of investors. It's the home of passive investing, as I call it, because we're talking about all things investing in markets, in secured loans, and other types of passive investments. So that's really sort of what I'm doing now, is really helping investors to invest better. That's how I would describe it.
Yeah, and just maybe tell us a little bit more about the Investment Academy program, because I know all of our members who have attended that over the last few months have just been giving rave reviews. So what actually do you cover on there?
We cover sort of investing in financial markets, and really my job was to kind of demystify that world. And I've got deep knowledge in that area. But what I used to come across was investors who were kind of almost deterred from investing because they saw the perceived complexity. And for me, my job is to, as I mentioned, to kind of simplify how people can invest. And my mantra is, the simpler you keep it, the more effective you'll be. And I've been sort of full circle. I got my CFA qualification, which is Chartered Financial Analyst, and I took things to pretty complex levels when you're working in the city, but you don't actually need that, and there's this whole thing about the financial industry, which is, deliberately complicates, using jargon and using various different techniques. And they only do that because the whole financial industry is so competitive. And, how do you differentiate yourself with your competitors? By trying to sort of create this perceived complexity. And then I just came out of that and I said, look, really the best way to succeed in investing is to keep things simple. And that's how I sort of structure my program, to demystify investing, to show people how they can invest in a structured, passive, low-cost way into ETFs and stocks and funds, really to sort of beat inflation and to get their money working harder for them than currently it may be, and to keep things low cost, of course, because that's one of the key leakages, which I know we'll talk about later. It's the three leakages I'm trying to encourage people to avoid are fees, taxes, and inflation. So that's a big area of focus.
Yeah. So let's start there then. So you talk about this concept of wealth leakages, and as you mentioned there, number 3 is inflation. We're going to focus on that, but reducing your fees, we know what a massive difference that can make, and there's some really interesting graphs and tables on your website, Invest Like a Pro, which illustrate that, right? Just how much that eats into your future profit, and then taxes as well. Obviously we know the benefit of utilizing those efficient wrappers such as ISAs and things like that. Is there anything else want to cover there just briefly so people understand what they should be focusing on
in terms of taxes?
Yes, and the fees, the two of those, the first two.
Yeah, so taxes are relatively easy to avoid. That's kind of what I would call low hanging fruit. So we have an annual ISA allowance. Everybody has an annual ISA allowance, which is enables you to invest in order to protect future gains, future investment gains, and future investment income, protect it, from tax. So these are tax shelters. So if you can, try to make the most of your ISA allowances. Same for your pension allowances. So you have, annual allowances in pensions, so in SSAS and SIP and regular pensions. So again, these are free gifts from the government, from HMRC, and you don't often get those, right? So, I'm always encouraging people to try and make the most of these allowances if you can. And as I mentioned, these are low-hanging fruit, available to everyone, not complex. All of the platforms out there enable you to sort of very quickly open up pension accounts, in SIPs or in ISAs, and SSASs I know are very popular amongst your members and property investors, and that's an amazing wrapper if you can sort of get exposure to SSASs as well. So, but they all achieve the same thing, which is to enable you to enjoy your investment gains in a tax efficient way. So that's taxes. In terms of fees, that's a really big one. So, we're all paying high fees, or we have at some stage have paid high fees. And that's because we don't necessarily know better, right? Most people are, they trust their pension provider. They trust their existing schemes. And especially if you've got a pension from work, you think that's automatically the best thing to be invested in, but not necessarily, right? You often get high fees and you often get put into investments which aren't suited to your own risk profile. So what we do in the academies is to kind of show people, ways in which you can invest, whilst minimizing your fees and invest better in passive investments and ETFs and stocks which have been proven to outperform in the long term. So that's what it is a key area of focus. So on average, if somebody comes along on the academy, and we have a sort of everyone gets an opportunity to go through their existing investment strategy wherever they're invested in, and we do a live analysis on the program. And on average, people are typically paying 1.5 to 2% per annum to their pension provider, and that might not sound like a huge deal on a sort of percentage basis, but it equates to around sort of £3,000 to £4,000 per annum per individual. And when you compound that up over 10 years, we're talking potentially up to £100,000 for depending on your pension size. And what I've been able to do is, people come along, say they're paying £3,500 per annum to their existing scheme. I can very, very quickly show them a way in which they can slash that down to below £1,000 per annum just by investing passively in low-cost platforms. Again, pretty straightforward to set up. And once you're set up in the right way, in using low cost platforms, using low cost ETFs, and in using a strategy which is suited to your own risk profile, that's pretty much a set and forget system which you can sort of just have running in the background passively and enjoy that compounding over the long term.
Yeah, great. So we know that the news is full of talk of inflation at the moment, but where has this all come from? Why are we suddenly seeing this all of a sudden? And what can we do about it, Manish?
Where has it come from? Well, I guess we have to go back a couple of years. I guess when we last spoke on this podcast, back to March 2020, when we all know what happened then. It was the pandemic kicking off, and I guess the roots of this current inflationary episode are planted in COVID. And we had the lockdowns, and then when we came out of lockdowns, there was huge supply shortages. And when the economies were returning back to normality, demand was increasing, and we were still having these supply shortages in energy markets, in oils, in cars, secondhand cars, technology, semiconductors, you name it. There were supply shortages going on, right? And so what happened was that there was a supply squeeze, and people were returning back to normality, and prices shot up. Prices shot up for most things, most goods and services. So that's that's almost like a sort of temporary dislocation. And then we had the Russia-Ukraine situation, which just added fuel to the fire, so to speak. And we just had an acceleration in inflation. So all of these things are kind of supply side related issues primarily. And, that's what's causing this sort of inflationary spike at the moment. So that's the cause.
And I know that you're quite passionate about, some of the figures that we see in the press and on the news might not quite be as accurate as the truth be told. So there's 3 types of inflation to be aware of. What are those?
Oh, yeah. Well, I've been a long-standing disbeliever of inflation, of official inflation data. And, back when, in the good times now, a few years ago when inflation was officially at sort of 1 or 2%, I was saying at the time, well, this is impossible, right? I was just looking at my sort of annual sort of price increases, in terms of food and energy and my telecom bills, right? Utility bills and broadband and all the rest of it. And that was going up well in excess of 2%. So I was saying at the time, look, inflation is really more like sort of 7-8% in reality. And we're there now. We're at 7% officially right now, but I still don't believe that number. So I would say, look, it's safe to assume it's 10% at least, if not 15%. And there's good reasons why the government would want to be hiding the real rate of inflation, right? And if you think about it, the government is the biggest debtor in the country. It owns the most debt in the country. And if the real rate of inflation was disclosed, there'd be pressure on interest rates to go up even more than they're going up now. And who's going to lose out the most? It's the government, and it's their own debt bill, which would just balloon out of control. So, I would say investors should assume it's more like sort of 10, 15, maybe even 20%, right? It's impossible to know. And everyone has a different inflation rate, of course, because the average inflation rate doesn't apply to everyone. There are three rates, right? So there's the official rate, which is what we hear about. There's the central bank rate, which is what the Bank of England forecasts in terms of what the next 12 months is likely to bring. And there's the investor rate, and that for you and I, for your members, for your audience, that's the most important rate. It's the investor rate, which is the reality rate, right? And that's the amount that our cash balances are being eroded on a day-by-day basis. And so that's really important to know that, what that rate might be. I mentioned we don't know precisely what it is, but let's say it's 15%, let's say it's 10%. So that means, every year your money is being eroded by 10% at least every year. And it's the silent killer, right? Cash is the only major asset class that's guaranteed to lose money on a day-by-day basis. So it's really dangerous to be sitting on a lot of cash for a long period of time because of that inflation erosion, which just happens on a day-by-day basis. So there's lots of things you can do about it. There are inflationary beneficiaries out there. Property is a good inflation beneficiary. Stock markets are a great inflation beneficiary, naturally, because if you think about it, when you're investing in stock markets, you're actually investing in real companies. And real companies out there are increasing their revenues by inflation, if not higher. And when that happens, their profits increase by inflation or higher. And when their profits increase, stock prices go up, right, to reflect that. So there's a very natural sort of sequence of events. And that's why a lot of people get surprised by why stock markets keep going up. And because they are a good inflation beneficiary. Historically, that's been proven to be the case. And within equities, and we cover this in the Investment Academy, actually. So we cover a whole range of different investment inflation beneficiaries. So we're talking about commodities, we're talking about infrastructure assets, we're talking about REITs, which are property-related equities, value equities, momentum equities. So all of these things are kind of, available to investors, essentially. So there's lots out there that you can do about it. It's not a lost cause by any means. There's an article I was reading on one of your blogs, Manish, and you were showing that with inflation, even up to 15%, that equities still produce results. So that was interesting. And, there's the term used, hyperinflation. Maybe you could just explain that for our listeners as well. So just going back to your previous point, look, historically, going back 100, 150 years, it's, equities have appreciated by on average 8 to 10% per annum. And there is a historical linkage between inflation and equities doing well in the absence of hyperinflation. So I think the study that you're referring to showed that as long as inflation stays sort of below 15%, equities have always returned positive real returns. So by real returns, I'm talking about inflation adjusted returns. So there's always been a positive linkage. The only time things get a little bit uncertain is when there's what's called hyperinflation. So, typically that's sort of greater than 15%. And when that happens, all asset classes are at risk, right? Property included, because then what happens is that bond yields start going up, interest rates will start going up, and then no asset class is safe. The only asset class that might be safe there is gold, potentially. But I don't expect inflation to reach 15%. I know things are bad right now, but I don't think we're going to get there. I think this is a temporary spike because of the supply side issues that we're seeing right now. I think by the end of this year, we'll start to see inflation sort of stabilize and sort of come down from here. And that's a good environment for equities to be involved in.
Mm. And what are your thoughts, Manish, on the interest rates? Do you believe they will have to rise to respond to try and combat the inflation?
Yeah, I mean, they are rising. They have been rising, across the world slowly. You can argue that central banks have been a little bit slow to raise rates, and I think that's right. They should have probably raised rates earlier, but they were a little bit uncertain about what was going on in the world. But now they're playing a bit of catch up. But, I think UK rates will probably go up to around 2% by the end of this year. But we're not going to get to 3, 4, 5%. I think that is, unnecessary, unless inflation becomes really sticky and sticks around at these levels, which, as I mentioned, I don't think it will. So I think we get to around 2, max 2.5%, and then we kind of, pause for breath at that point. In fact, the Bank of England has recently come out and said that, they've started expressing concerns about potential slowdown in growth. And in that environment, they're not going to keep raising rates aggressively. So I think we get to 2.5%, and pretty much, that will probably, be the peak for interest rates in the UK.
Mm. So many of our listeners, Manish, they'll be business owners, either traditional businesses or, property investors as well. So, any other impact for those two classes of people that they should be, thinking about, things they can be doing now just to kind of protect themselves?
I mean, look, if you're really concerned about interest rates spiking, even further than what I've just mentioned, so, I think we'll get to 2.5%. If you think we're going to sort of get to 3, 4, maybe 5%, then, look to fix your mortgages for a start. That's the first thing you can think about doing. Go for 5-year fixes, longer term fixes to protect yourself from interest rate hikes. That's the most obvious thing you could be doing. What else? If you're a business owner, then you've got to be mindful if you're taking out business loans and things like that. We've already seen, student loans, which is a different different sort of situation altogether. But student loans have really spiked in terms of interest rates. But if you've got a lot of debt on your balance sheet as a business owner, or as an individual, if you've taken on lots of debt, just be mindful that interest rates, there is a risk that interest rates could go up, if inflation was to prove to be sticky, and if central banks decided, well, look, we really need to be aggressive in our fight against inflation. That's not my base case, but if you think that's going to happen, then you might want to protect yourself by fixing your mortgages or loans for a longer term, on a longer term basis. So that's the obvious thing you could be doing.
Okay, so that's given us a good summary then, Manish. Is there anything we've not covered, anything you've been writing about recently, or questions you've been getting asked that you think would be useful to cover?
I think, a lot of people who I talk to, they're property investors, and in fact, around 80% at least 80% of the attendees on the investment program I run, they're property investors. But when they come along, what they want to be doing is to be diversifying. They kind of see property as a great asset class. Look, don't get me wrong, I'm in property. I like property. That's one of my main asset classes. But I think people need to think about diversifying, and most people who attend the program are there to sort of learn ways in which they can diversify. And stock markets, options is another asset class I cover. These two areas are really good ways to diversify alongside property, not away from property, but to be diversifying alongside property. And some of the common concerns I get are, and I get this, with property, it's not passive, right? And it's stress. If you get some funny tenants, I call tenants, toilets, and boilers. Those are the big three stresses with property, right? And you get called out with property. There's effort required, right? You can't just sort of run property from your laptop, for example. With stock markets, you can, and stock markets can be very, very passive, and they can be tax efficient, right? And you don't get the same tax efficiencies within property. There's in fact, the tax changes we saw a few years ago, I think they're just the start, and those will just be increasing over time, because property investors are an easy target, right? And let's face it, there's a hole in government balance sheet, in government finances. They need to raise taxes, and property investors will be an easy target going forward, and the regulations will probably keep increasing as well. And that's why property investors are looking for ways to diversify. And stock markets are a natural way to do that. And the only kind of concern people have historically had with stock markets is about volatility. And, I show investors how you can invest whilst minimizing that volatility and earning decent returns at the same time. So people sort of come along and they have very balanced, diversified portfolios. I show them ways in which they can sort of be balanced and sort of reduce that risk. And you can invest in things like factor ETFs, which give you, exposure to low volatility equities, but which have also sort of historically made decent returns. You can get exposure to income producing equities, which again are very stable in nature, but they give you a really good dividend yield. We're talking between 4 to 8% per annum. And people are getting really interested in options, which is also part of the Investment Academy program. So we have a whole module on options, and people get very excited by options, and I do. And it also happens to be one of Warren Buffett's favorite strategies, because it's such an incredible asset class. And we're getting, I'm getting, some of my investors are getting, anywhere between 2 to 3% per month returns on options. So that's another sort of area which people are seeing a lot of interest in.
Yeah. It's a great way to generate recurring income, and that's the obviously the name of the game with WealthBuilders. And it's so good to have you as one of our trusted partners with all of your expertise in certainly around Pillar 2, the investment pillar, which we've been discussing today, Manish. So where can someone go if they want to find out more about the program that you run?
Website is investlikeapro.co.uk. That's the main website. If you want to find out more information on the program itself, I know you'll be sending out some information, Chris, and there's some stuff on the WealthBuilders website. But the direct link is investlikeapro.co.uk/investing, which kind of gives you, all the information around the program itself.
Brilliant. Well, thanks so much for sharing with us today, Manish. Good to speak to you as always. We'll catch up again really soon.
Great. Thanks, Chris. Speak soon.
Okay, so lots of points there for us to debrief on in just a moment, Kevin. Before we do that, let's head to Trustpilot and read out one of our latest reviews. This one is from Dooley Boy, who says, it was whilst researching all things SaaS that I first discovered Kevin Whelan and then the WealthBuilders' excellent podcast, which always delivers great weekly content. You really must check out the back catalogue. I have since joined the Academy, and wow, what a great idea. There is a clear roadmap in place with a fantastic level of detail that is adaptable to suit all existing levels of experience. It is backed up with truly genuine and accessible support from Kevin, Christian and Richiko, along with Chris, Paul and Gary from their wider team, and also from within the WealthBuilders community itself. And with the help that we have received, we have set up our SaaS and we now stand at the start of what will be an incredibly exciting journey, and one which will go on to provide an excellent legacy for our children, all three of whom have now started to embrace the possibilities that the SSAS offers, as well as seemingly adopting a wealth builder mindset in an osmosis-like manner. Wow.
Is that the longest review we've ever had?
Well, I think things are rubbing off there with Dooley Boy.
Well, I'll tell you what, Dooley Boy sounds a bit like Del Boy, but he's very articulate.
Fantastic member
Osmosis.
of the community.
I don't think we've had the word osmosis.
I
like osmosis because it's sort of like a transforming impact, permeating his pores from within, which is enabling him to sort of get his mindset right, not just for himself, but to be a brilliant steward for the next generation. I mean, that's just a wonderful review.
Yeah, we love that one. So thank you once again for that. Okay, so what did you pull out there from the conversation with Manish?
Oh, absolutely nothing. Let's end it there. I mean, what I would say is, he's coming from a place of clear understanding of how markets work. And while he and I might have the occasional disagreement about the role of the market in building wealth, I believe that for the most part, when people are investing in the market, they're not doing so deliberately. They're not doing so with the intention to create cash flow. They tend to fall into the accumulation model, which is sort of buy and hope, as opposed to hold and deliberately diversify and deliberately create ways to sort of mitigate risk. However, so he and I might disagree on that, but there is a role for the stock market. And I think if you listen to what he had to say, he's really talking about inflationary pressures, both in terms of fees, inflation, tax. So if you just use what I normally do, Chris, and can I find an acronym in that? Is your investment fit? Fees, inflation, tax. And of course, the big issue right now is inflation, but we mustn't minimize our understanding of the impact and the reduction, therefore, in the value from fees and also from tax. But just to touch on Manish's viewpoint as well, that he talked about the current problems with inflation are supply side driven. Now, I'm an economist by training, so let me give the counter view as well, that inflationary pressure, the pressure on prices, yes, can come from either the inflation side or the demand side, which is when there is so much pent-up demand that what tends to happen then is when the demand is very, very high and the supplier of the product, service or whatever sees, hang on a minute, there's a huge demand, they put the prices up. So that's because they want to make more profit. And of course, he mentioned that in inflationary times, companies almost accidentally can make more profit, which means the stock market, at least big companies, who are participating in those services where that inflationary pressure is there, can be making more profit, and therefore their value can be a hedge against that inflation because they're making more profit in line with inflation. So definitely I agree with Manish as far as that's concerned. And I definitely agree with him that you've got to pay attention to the tax side of things. Use it or lose it, as they say, and take advantage of your ISAs, take advantage of your pensions, because wherever you can invest, where there's no artificial reduction in somebody taking money out of your life, basically, then it's important to do that. So all tax-free allowances should be used. So I agree with him on that. And I think the other point he mentioned when he talked about tax was enjoying tax-free returns. I want to flip that a bit and say you should enjoy returns. Enjoy it. You'll find pleasure in investing, whereas so many people find fear in investing. And the only way you can find pleasure in investing is to know more about how investing works and know more about yourself. So many people get caught up in investing in standard things that somebody else has designed by accident, by ease, really. Employers set up schemes and funds that are designed because, well, it's just easy to offer the same thing to everybody, which may have no reflection on who you are as a person. So I would say spend time with somebody who knows more than you do about the market and help you understand how you can invest in line with your own personal DNA, whether it's value investing because you like certain companies, whether it's building kind of a core holding in low-cost investments, as Manish mentions, and then build some almost ideas around the outside. So you might hold a range of passive funds because you want to keep your costs down, but you might want to dip into, well, what do you think is happening with the world as far as electric vehicles are concerned? What do you think about nitrogen cars? What do you think about green energy? What do you think about? So that your opinions can reflect your investment choices. And that way, you're bringing your investments to life to reflect who you are, not somebody else.
Yeah. Manish mentioned about ETFs, but perhaps we can explain a bit more about what an ETF stands for.
Yeah, and I think ETF, exchange traded fund, is just another way of being able to buy into the stock market. So just as you go buy your shopping, you can either buy it from a local store, buy it from a supermarket, or go and buy it at cash and carry at wholesale prices. Essentially, an ETF is a wholesale priced stock or a fund. And they can be very, very narrow and very specific, which means instead of buying a big, big fund like FTSE 100 or the S&P 500, Standard & Poor's, the American version, you can narrow down and say, I want to own gold stocks or mining stocks or something very specific. So you can zero in and focus on the areas where you might be interested. So ETFs, just another way of holding money in the market, narrow it down where you want to go at a fraction of the price you would normally pay for big funds, or in America they call them mutual funds, where they tend to be heavily loaded in terms of fees. And I think he's spot on about fees. Most people are paying 2%. And I'm going to repeat my challenge that I did, I think, last time, Chris, which is we believe that anybody who gets in touch with us who's got money in the market, possibly not reflecting who they are, possibly by default, we believe we can save you 50% in charges. Now, in inflationary times, if you can reduce something by 50%, you've done a good job. If you can reduce it by 10%, you've done a good job. 50%, all you need to do is drop us an email at hello@wealthbuilders.co.uk and we will do our best to do that. And if we can't do it, it's all free anyway.
Yeah.
Nothing to lose.
Yeah, definitely take advantage of that. Drop us an email, as Kevin says. Just put a clear subject line there, reduce fees, Wealth Talk podcast, and we'll definitely get back to you and pick that up. So, okay, that was interesting. Obviously, one of the things Manish talked about was diversification as well.
Yeah.
Talking about perhaps, property investors looking to diversify into pillar 3 investments. But of course, we know the 7 pillars.
Yeah.
So diversification definitely gives people peace of mind, security. It kind of, smooths things out, especially when there's difficult times.
I think if you can find a way that over time you can build your wealth deliberately and conscientiously in multiple pillars, you become financially bulletproof. And that's the idea of diversification. Most people, I have conversations with people and say, well, diversification is really important, and not at any cost, but they say, oh yeah, well, I'm already diversified. I say, what do you mean? I say, well, I've got 20 stocks or 30 stocks. Well, that's not diversification, that's diversification. If you don't know what you're doing, you've just bought more and you think you're doing better when actually you don't know what you're doing. And this is where I like the Buffett definition of risk, which is when you don't know what you are doing. So the risk is always in you. And what we believe is if you learn more and take some time to be taught, be humble enough to be open to it, you can learn not just the enjoyment side of things, but I believe that Manish and others can teach you in a month what an IFA would know about managing funds that they charge you for a lifetime. So a few hours of learning can remove the fees that somebody's going to put in for life, because it is quite simple. It's not as complicated as anybody thinks. And that's the reason why, as an IFA myself, I pride myself on keeping costs down. Show people what to do, then they know how to do it, even if they don't choose to do it themselves. It's always better to know what needs to be done, because as I I believe there's no investment that's passive. You've got to know what needs to be done in order to delegate the work. But if you don't know what needs to be done, the delegation becomes abdication, then you're hoping, and hope is not a good plan.
No. And we've got numerous stories of members of our community who we've saved thousands and thousands of pounds for.
Yeah, I mean, there's just some, just go to our Trustpilot reviews. But the other thing I've mentioned that sort of ties up what Manish said and my little quote there with Mr. Buffett is the issue of how do you create an income stream from the stock market? And it's good to know that. And while it might not be right for everyone, Warren Buffett, and I know Manish teaches this as well, about options. Mm-hmm. And while I'm not going to go into the technical details of options, let me give you a simple analogy, Chris. If you know about pillar number 4, which is owning a portfolio of property. Now, if you imagine you're going to buy property and you think about, well, I'm going to buy some property and I'm going to build my wealth through property, but you buy the property and you leave it empty. So you're only going to get one stream of income, which is the increase in the capital value of the property. So you buy something for 100 grand and in the future you may sell it for 200 grand. Yes, you'll pay some capital gains tax because, as Manish said, there are less benefits in the tax side of things in owning residential property than other types. Commercial property can work differently, particularly if you combine that with your pension. However, going back to the story, you wouldn't dream if you were a property investor and saying, well, I'm just going to leave the property empty. You'd want to get 2 streams of income. Number 1, the capital appreciation, or you hope for capital appreciation, and over the long term, you'd expect it. But number 2 is you want a rental income. Well, that's what Mr. Buffett does. So he has a high holding of stocks, which he's keeping for the long term. When you hold a lot of stock, that's called a position. So when you have a large position of money in stocks, other people who don't have that position want to temporarily borrow that position or some of your position. They want to borrow your stocks. Why do they want to do that? Well, they want to try and create some revenue from the sale of an option or the purchase of an option. So they'll think the stock's going to, they'll want to create a value from it. So they'll borrow your stock if they need to, or buy it from you. So if they borrow it, so they've got the money to fulfill an option, you get a premium, a rental. But if they exercise the option, they're going to buy it from you. Well, if you've always set the option price to make a profit, you're going to make a profit either way. Mm-hmm. And this is teachable. Not for everybody, definitely not for everybody, but it's teachable and it isn't complicated at all. So you can learn it, you can embrace it. I went on a course to learn it, understood it, didn't think it was for me, but that's me. You might be different. Manish would definitely be different. Somebody else would be different still. So by understanding the things, you get to determine what you like, what you don't like, and that's better than being constantly in the dark.
Mm. And that fits really into our recurring revenue roadmap, is about understanding the different pillars that are available, the different strategies within those pillars, and then turning the wheel of wealth. And that's the process of a little bit of education, some support, connection. And as you say, sometimes you might turn the wheel, decide it's not for you.
Exactly right.
Put it to one side and try something else.
And that's part of it. That's the whole part of the wealth building thing, is when you can go somewhere, and I'm delighted and proud of WealthBuilders being, as far as I know, Chris, and anybody who could correct me by sending me an email, we're the only completely holistic and impartial organization that deals with wealth in its totality, the 360-degree view of wealth, not the myopic view of stocks, property, funding, commodities. So because we take that holistic view and we partner up with the best people we know, then we're able to bring that knowledge and bring that integrity as the safest place we can be for people trying to build their wealth, rather than, I suppose, leaving the shore and getting into shark-infested waters. So we want to be a nice, safe harbor for people And I'm proud that we continue to do that.
Yeah, and we offer all different levels of membership. You can begin as a free member. Just head to wealthbuilders.co.uk/membership. Sign up, won't cost you anything. Get access to some of our videos, our ebooks. And for those that perhaps want a little bit more coaching support, then we've got the Academy. And,
and other things coming soon, including Wealth Builders families. And I know you've written a fantastic 200-page workbook for people who want to perhaps go on a self-guided tour. Nothing wrong with that either. So we needed ourselves, didn't we, to create the whole picture before we could then say, well, here's how to navigate yourself through these waters, as opposed to us actually steering them through it. And that will mean very soon we'll have a lower cost offering because we won't be coaching them. And I think I'm looking forward to that. And that will be sometime pretty soon.
More news soon. Absolutely. Yeah. Okay, good. Well, I think that wraps up our 150th episode.
That was a good one.
Indeed it was. So thanks again to Manish for his insights on today's episode. Hope you enjoyed listening. If you haven't left us that review, now's a good time. Just head to wealthbuilders.co.uk/reviews. Take a couple of minutes out. Just let us know that you're enjoying it. We would really appreciate your feedback.
Yeah. And if you've enjoyed the podcast, my name is Kevin Whelan. If you haven't, it's Christian Rodwell.
All right. On that note, we'll catch up same time, same place next week.
Until then, my friend, see ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the Wealth Builders membership site to help you create, build and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.